Everyone keeps asking me the same question this summer. When is San Diego going to finally crash so that they can afford to buy a home? Here's the honest answer. It isn't. I'm gonna show you the 3 things that would have to happen first for a crash to take place, none of which are happening right now. Oh, and that Fed meeting that happened last month where they held rates steady, 3 of their own people voted to raise them. Let me show you what that means for your rate this upcoming fall. I'm Karl Kyler, your San Diego realtor, and this is your August mortgage market update with Matt Kish from Movement Mortgage. Every month, Matt and I break down what moved mortgage rates, what the bond market is signaling, and what you should be thinking about over the next 30 to 60 days. No hype, no noise, clarity you can make a decision with. Now, let's get into it. According to Mortgage News Daily, the source we use for all our rate data because they update every single day, here is where things stand as of right now. The 30-year fix is sitting at just shy of 6.75%. The 15-year is at 6.25%. Jumbo loans are at 6.85%. FHA is at 6.28%. VA is at 6.30%. And the 7-year adjustable rate is sitting at 6.29%. Here is what stands out about July. It was the highest point of the year for mortgage rates. The 30-year opened the month around 6.6% and climbed and closed the month out at 6.83%, the highest level we had seen in all of 2026. That climb is real money on a $750,000 loan, which is close to a typical San Diego purchase after your down payment. That move in July is about $120 more a month. Step back to the year's low near 6%, and that gap is bigger, around $410 a month for the same house. So about 5 G's a year. Here's what pushed rates up. The conflict overseas kept the bond market on edge all month. And at the end of July, the Federal Reserve came out swinging against inflation. The strange part is that a fresh inflation report in the middle of the month came in cooler and rates still went up to their high for the year. Now I'm gonna unpack why that happened in a few minutes because it's the whole story for this month. But first, one reminder before we go any further. These are national averages. Your rate depends on your credit score, your down payment, your loan type, and your lender. Matt Kish is the person who turns these averages into your actual numbers. So what do these rates mean for you when you sit down with a lender here in San Diego? I asked Matt to break down the real monthly payment, which loan type he is steering people towards at these levels, and the one thing you can control that moves your rate the most. Here's what he had to say.
For most San Diego buyers, these rates are creating more pressure, but they're not shattering the dream of ownership, right? What we're seeing is buyers becoming more selective and more strategic as these rate environments kind of progress. Instead of stretching to the top of their approval amount and just stretching the envelope, they're focusing on homes that fit within their comfortability and monthly budgets more so. The biggest factor today isn't the rate itself. It's a combination of everything. It's rates, it's home prices, it's taxes, it's insurance, it's overall affordability. And that's why I spend more time talking about overall monthly payment than I do like headline interest rates, just because interest rates are super juicy. We need to be sitting down talking about affordability and overall monthly payments concerning that rate in any particular time. As far as loan products, I'm seeing way more interest in FHA, way more interest in VA, and a few people that need to be talked out of adjustable rate mortgage, but there's still people that need to look at adjustable rate mortgage options as well, if it fits their needs. And if they need some payment flexibility in the amount of time they may or may not be living there. And for well-qualified conventional borrowers, we're also exploring temporary buy downs when the seller is, throwing money into the pot. We may be looking at temporary buy downs instead of just taking the credits for closing costs. Every situation is different, but the goal is always going to be the same. Like, create a payment that works today if rates don't come down, right? Everybody's expecting, rates are going to come down in 6 months, rates are going to come down in a year. If we've known anything in these past few months, is it's just kind of building up and getting worse. Like, it hasn't gotten better, and there's no sign ahead of us that it's going to get better anytime soon. So we really need to be comfortable with the payments we're going into right now. The loan products, obviously, we're going to look at every one, FHA, conventional. If you could qualify for VA, Great. We're going to look at that too. We're going to place VA against conventional, against adjustable rate mortgage. Whatever we have to look at, if it fits in the mold of your monthly plan, that's what we're going to do. And that's what we're going to, break down and look at.
Big question. Will San Diego home prices crash in 2026? This is the number one question in my inbox. So let's handle it head on. For prices to crash, and I mean really crash, not a scary headline, 3 things have to be true at the same time. Right now here in San Diego, 0 of them are. Number 1 is a lending boom that goes bust. Back in 2008, anybody with a pulse got a loan that they had no business getting. That is illegal now. The rules have changed. Today's buyers have to prove income, prove savings, and qualify for real. Number 2 is a flood of homes hitting the market with no buyers to meet them. We have the opposite problem in San Diego. We do not have enough homes, not too many. And number 3 is forced sellers, people who essentially have to sell at any price because they owe more than the home is worth. The owners I work with here are sitting on years of built up equity and locked into low fixed payments. Nobody is being forced into a fire sale here. So the next time someone says that a crash is coming, ask them, which one of these is happening? If they cannot answer, they do not have a forecast. They have just a feeling, more so maybe just a dream or a hope. Could prices go soft or flat for a stretch? Sure, but flat is not a crash, and waiting for a crash that has no fuel behind it is one of the most expensive mistakes a San Diego buyer makes. Now here is where Matt sees something that I never will. A crash starts inside the loan files, long before it ever shows up in a headline. So I asked him, for where he sits writing loans every day, how the credit quality of today's buyers in San Diego compares to the 2008 buyer, and whether he is seeing any early stress in the numbers that he watches. Here's what he had to say.
So Karl, the borrower I am seeing today is dramatically different than the borrower we were seeing leading up to 2008, man. It's just night and day. Today's loans require full doc, right? Verified income, verified assets. The word verified anywhere in that sentence makes it way different than 2008, right? And much tighter underwriting standards. Like there's actual underwriters and then there's automated underwriters, and then there's underwriter bosses, right? So the underwriters are definitely going to have their say in what goes on in loans, and not so much the loan officers having the say of what goes on at the end of the loan. Borrowers generally have stronger credit profiles, more money in the bank, and way more equity usually when they're moving in now than when they did in 2008. Back then, loans were being propped up and approved on the assumption that home values were going to go up. And today, lenders are focused on the borrower's affordability and able to pay back that loan, right? So it's just a fundamental difference in how you get your money. Banks aren't really concerned about how quick your home is going to be valued, as opposed to, can you afford this loan? As for like signs of stress out there, right? There are always going to be pockets that we need to look at, right? Higher rates, higher consumer debt has definitely stretched where we're at as far as household budgets. We're still in a comfortable spot as far as, nationally. The bubble hasn't popped as far as consumer debt, thank goodness. But we're still in a good spot where the household budgets, even for first-time home buyers haven't really ballooned too far yet. We occasionally see some tighter debt to income ratios and shorter cash to close right now, just because there is a little more stretching. But again, we're still within the constraints of being able to lend to a lot of these borrowers, right? And that said, I'm not seeing crazy widespread credit deterioration yet, but we kind of see it coming down, right? We kind of see it coming down the pipe. Like household debt is the highest it's been ever, right? So that bubble is there, but right now, in the now, I'm not seeing it too much yet. Delinquencies remain relatively low in my world, and most borrowers are entering home ownership right now with way stronger profiles than 2008. So it's simply just apples and bananas when we're comparing the two. That's great news. Like home buyers today are much stronger than they were 18 years ago. And that's great. Even first-time home buyers are even stronger than people that, might have owned a home back then. So when we're looking and comparing the two, we really can't compare. We just got to look into the now. Credit, collateral, capacity to repay the loan. If those are strong, we got to talk. We got to get you in.
So let's talk about a hawkish Fed and what moves your mortgage rate. Last month, I told you that the Fed erased the rate cuts that it had planned for this year. In July, they went a step further, and this is where it gets interesting. Starting with the twists, a new inflation report came out in the middle of July and it cooled off. The headline number dropped to 3.5%, a serious improvement from the 4.2% I showed you last month. And this is primarily helped by a big drop in gas prices. Normally, cooler inflation means lower rates. Instead, rates went to their high for the year. So what the heck happened? What happened is the Fed. At its meeting at the end of July, it held rates steady in a range of 3.5 to 3.75%. But 3 of its own members voted to raise rates and not lower them. The head of the Fed said this group will not waver on inflation. That is not the language of people about to make cuts. And the market heard it for what it was. There's a tool called the CME FedWatch tool that reads future contracts to show the market's odds of what the Fed does at each meeting. Think of it as the market's live best guess. Coming out of July, it puts the odds of a cut at the next meeting at 0, and it has a rate hike at almost a 45% chance. Here's the myth I need to bust because it costs buyers money every month. The Fed does not set your mortgage rate. Your rate follows the 10-year Treasury, which is the bond market, and in July, that Treasury climbed to 4.75%, the high end of its year. When the Fed talks tough on inflation, the bond market gets nervous and the Treasury rises and your rate rises with it, even in a month that the Fed technically did nothing. So if you're waiting on the Fed cut to rescue you, you're watching the wrong scoreboard here. And the cost of waiting runs in the wrong direction. San Diego prices creep up a little most years and rates may go up before they come down. On a home around $1 million, a 2% rise while you sit on the sidelines is another 20 G's on the price. And on top of a rate the market says is more likely to rise than fall. So here's your one move for this week. Get a real pre-approval and have your lender show you what a lock and a buy down look like at today's numbers. So you're making a decision based on math and not headlines. That leads straight to Matt. And I asked him if rate relief may not show up until deep into the fall or even next year, what should a buyer be doing right now? When does it make sense to lock? What is a float down? And which of these rate buy downs you see advertised everywhere pencil out versus the ones that are being marketed? Here's what he had to say.
My advice is not to build home ownership around future rate cuts, right? Like we don't have a crystal ball. We don't know what's going to happen in the future. Buy when the payment works. Buy when it fits your needs. Buy when you're financially prepared. Not because you're trying to predict what the Fed's going to do or what the mortgage market's going to do in fall or early next year, right? It's not a logical and sensible way of doing things. It's affordability. And if the payment works now, let's start now because we know what happens if we sit on the sidelines and wait any further. We've seen what happens to values and rates as these years have gone on, as we've talked over and over again, right? So let's not try to crystal ball it. Let's do it when it fits your needs and when you're prepared and when the payment works. When a buyer finds the right property, payment makes sense. I generally lead toward locking, and we're having these conversations leading up to escrow too. We're having, the total cost analysis questions, the rate questions. What does my payment look like if the rate changes a quarter on our way into escrow or up or down? It doesn't really matter, right? But for when it makes sense, I generally lock immediately when we get into escrow. If the market smells like it's going to shift at all negatively, I'm locking because we've already had this conversation leads up. A lock provides certainty during the time of the transaction. It's locked. There's no movement. Doesn't matter what, the market could crash. Rate is locked. So it's all good. I want to lock the minute we get into escrow because even sometimes escrows are pretty short these days. We're trying to close this loan quick. So a 2-week escrow is even better for me, right? So let's get you into the escrow. Let's lock. For buyers concerned about rate improving after they lock, there are some float down options, but that's when rates improve in the first month or two, 100, 200 basis points. And we just haven't seen that kind of movement in the market since 2020, right? Like it would take a full blown pandemic type thing to be the case. But there are those options. Some lenders do offer them. We could sit down and talk about your situation if that was to occur. There's management that can make calls and stuff like that. So there are options for everything. Float down options after we lock and after you close could be a case, a recast. It just kind of depends on your situation. Regarding buy downs, right? There's temporary seller paid buy downs that can be effective. Again, if the sellers are throwing money at the pot, we got to take a look. Hey, do we have money for closing costs? Let's use this seller credit and get our monthly payments lower for 1 year, 2 years, 3 years, however long, we could stretch that thing. And permanent buy downs can also make sense, but only when the borrower expects to be in the loan long enough to recoup the upfront costs, right? Especially right now, I'm going to talk you out of a permanent buy down. I just am. I'm going to show you the math and how it doesn't work unless, again, you're only going to be in that loan for a period of time where it makes sense, right? For you to actually throw that money at it and buy it down. But right now, we're not trying to throw more money at the pie because it's a volatile rate environment. Not trying to do that. There are some advertised buy down programs. Every lender has their own thing, man. There's a program with other lender in Chula Vista that was really hot. It's an internal program. We don't have it, and good for them for having it down there, right? But again, lender, everybody's going to have their own programs to kind of help you out if they can, right? But as far as refinancing later, I encourage buyers not to assume that's going to happen. We don't know what's going to happen. Again, getting back to the crystal ball, like we don't know what's going to happen. So let's make sure that we're comfortable now and let the cards fall, right? If we're good to go and we're comfortable with the payments now, let's go. A refinance makes sense when the savings outweigh the costs. So we really got to get a much lower rate quick for you to really, really recoup the cost of refinancing. So again, is that going to happen in the fall or beginning of next year with what I'm seeing? Not going to happen, right? We're just not there as far as the war, as far as a lot of things that are really swaying the pendulum of how this market's going to go. So we really got to just focus on the now. And if you're in good standing, the 3 C's, credit, collateral, capacity, we got to sit down and talk about, can you afford this? And if you can, let's get to it.
All right, so here's the big picture coming out of July and into August. Rates hit their all-time high for the year, and they got there because of a tough talking Fed and a nervous bond market, not because the economy fell apart or inflation ran wild. In fact, inflation cooled off last month. At the same time, the crash that so many people keep waiting for has no fuel behind it, because the lending, the supply, and the equity all say otherwise. So here's my honest read to you. Do not plan your life around a rate cut that the market says is more likely to be a hike. And do not plan it around a crash that the data does not support. Find the home and the payment that makes sense for you today with a clear head, and keep the door open to a refinance later if rates ease. The people who win this market stop waiting for a rescue that is not coming, and they start deciding on the facts in front of them. If you're also tracking the San Diego housing market itself, the inventory, the pricing, what is moving and what is not, that is what my weekly San Diego Market Matters series covers. Go check those out when you finish here. And if you have not subscribed yet, now is the time. This market moves fast, and the buyers who make smart moves this year are the ones who understand what the data is telling them. This is where we sort through it all together every month. Hit that subscribe button before it votes for a rate hike as well. As always, I'm Karl, your San Diego realtor. I'll see you in the next video.